Everybody, welcome back to this 17th episode of The Growth Factor. And one thing that I've noticed in really researching topics and talking to investors right now, like our pipeline has significantly opened up over the last 6 months, really because of what's going on in the stock market right now and the uncertainty with Iran and with inflation and with oil. Yes, oil is down just under $100 a barrel right now, but there's a lot of uncertainty going on. And so one of the questions that I've been getting asked over and over is, what exactly is private equity? And so many people have heard get into private alternative investments, counter-correlated investments to the market. But then the question is, how do you do that? And where do you go about doing that? And what does that look like? And so that's what we're going to talk about today. I've got Boone on, our CFO and my brother and business partner for 21, 22 years now.
Yep.
And then also, as always, we've got Brian, our managing director, on as well. So Boone's going to go through and ask some of the common questions that we've been getting and or the questions that you should be asking if you're looking to, and you should be looking to reallocate capital right now out of the equities market and into private investments. This is when the wealthy, these types of market conditions is when the wealthy create their wealth and they really compound their wealth. But there's strategic ways to go about doing that. And so that's what we're going to talk about today. You don't want to miss this episode because we're going to dive into what you should be looking for, when you should be looking for it, what types of things are the extremely wealthy looking for and where are they allocating their money and how do they get access to those things is what we're going to dive into today. So Boone's going to kind of go through and ask those questions, and then Brian and I, based on our experience, will fill in those blanks and answer those questions for you. So let's get it started, Boone. If you'll take it from here.
Yeah. Hey, everybody. Excited to be back. We got a lot of good stuff to cover today. Recently the public markets have, led the headlines of one day it's the S&P loses, 2 trillion in cap space, and then the next day erases all those losses. And so we're seeing, a ton of volatility in the public markets. And as Ty kind of alluded to, now is a time that, and Brian will get into a little bit of this later, of when it makes sense to take some chips off the table, when to reallocate and rebalance your portfolio. And so we're going to get into what's the difference of private versus public sectors today and what are those alternative investments. So the first question we get a ton is, to the person that is traditionally in the public markets, what in layman's terms is private equity? Ty, why don't you start us off with really defining what private equity truly is?
Well, instead of going in and define, kind of paint a picture, and private equity is at its, plain English, exactly what it says. It's private business opportunities. So think of it this way: instead of buying stocks in a publicly traded company, going on to whatever your favorite trading website is, or your financial advisor, and buying public stocks like Walmart, Nvidia, Tesla, whatever the case may be, any publicly traded NASDAQ, Dow, or any of the other smaller markets. And yes, we've got a Texas market coming everyone's way, I believe. But that being said, instead of buying those public stocks, you're buying direct ownership in real businesses and real tangible assets. And so, think of buying a public stock. You're renting that stock, and with private equity, you're buying direct ownership. You own a piece of an operating business, and if that operating business owns real estate as well, you own that real estate. So you've got physical, tangible assets and direct ownership. Also comes with that is a time horizon. So typically when you're buying into private equity, this is investment in a physical asset, a physical business. It's direct ownership. And so you're going to have a capital commitment timeline. Uh, that comes though with fewer price swings. You're not going to be sitting there looking at your investment on a daily basis saying, what is it doing today? Now, with that said, we've got about 750 investors, and I could name two of them right now that think that their investments with us in private equity changes daily, weekly, or monthly, and we constantly get a call about that. That is not the case. It's more operator control. So where the business goes is where the value goes of that investment. With that, you can kind of boil that down to with private equity and specifically real estate. You're investing in something, you're buying to improve whatever it is that you're buying or grow it, restructure it from a capital's perspective. Oftentimes that comes with new debt, allocating new debt. So you buy with bridge and investor capital. You implement the business plan, improve the business, restructure the capital, bring new debt in that's oftentimes more competitive, and then you hold and exit. And so that's in plain English, what really private equity is. But what it does and what it focuses on, private equity is what wealthy people mean when they say ownership. When they say you should have multiple streams of income, when they say you should have direct ownership, private equity is what they're talking about. And we'll talk about the multiple streams of income or the streams of income from private equity a little bit later. Not all of those. That doesn't mean when they're saying multiple streams of income, that doesn't mean just cash flow in a monthly basis and what you may be thinking about. So we'll get into that a little bit later. And then Brian, why don't you step in too from your perspective in the equities markets, a long career in the equities markets. What do you think of, and what have you thought of in the past prior to being involved on a day-to-day basis in private equity? What was your thoughts on private equity, and how would you have explained it prior to being a part of the Lasater Capital team?
Yeah, it's a good point, Ty. Thank you. And I think most people, when they think of private equity, that's something that's usually reserved for the high net worth or the ultra high net worth type client. That I may not have access to something like that. If I'm a new investor or a quote unquote small time investor, then I generally am going to invest in public markets. I think it's important maybe to back up a step and recognize that not all large companies are public and not all small companies are private. However, that being said, a vast majority of companies across the United States are smaller companies. And so when you look at the overall opportunity, the private market side, there's roughly 18,000, 18,500 private companies that have revenues of about 100 million or more. Compare that to public markets. You would think, between every store that you walk into on a daily basis, Walmart or Home Depot, that would be the larger number of companies. It's actually about 2,800, about 3,000 companies are public companies. That's down significantly from just 30 years ago. There was around 8,000 publicly traded companies about 30 years ago. So from an opportunity standpoint, there is a much larger opportunity set within private markets, but it's not something that's just reserved for the high net worth or the ultra high net worth. Access to private markets has certainly opened up quite a bit in more recent years. And as a typical investor who has a lot of experience investing in public markets, it's really all about access. It's knowing where to go and having the right relationships in order to access these types of investments.
Yeah, I think you bring up a really good point there, and with just pure volume, the opportunities are out there. If you just look at the number of companies, and you mentioned revenue size and creeps up over 20,000 businesses that hit the $50 million mark. We hit that for the first time, Boone, 4 years ago, I believe. And I would still consider us a small business. And we hit, I think, what was it, $54 or $56 million in revenue for the first time 4 years ago. And that's relatively a small business, but we're private. And that is larger than some publicly traded companies. And so you were talking about access, and you know, it in the past, historically, the extremely high net worth individual and the uber wealthy were the ones that had access to private equity. Now they're still the ones that have the majority access to private equity, but access has opened up. But you may not hear about it as much, and so it's knowing the right person. I think is kind of how you said that, Brian. Having the right connections in order to find the right opportunities, and we'll talk about what that looks like closer to the end and how you can find some of those opportunities. So, Ben, I'll turn it back over to you.
I think it's also important to notice some of the tax differences in investing in the public markets and investing in private markets. When you invest in the public markets, traditionally you're just going to be tracking your basis on a Schedule D on your 1040, but you get no ongoing tax benefit on a year-over-year basis. Whereas when you invest in real estate with operators such as us who pass through the taxable losses that are non-cash, like depreciation on a year-over-year basis, you create a tax benefit to that investment that is ongoing. So I think that's important to notice as well.
Boone, you brought up a really good point there, and I have an accounting background as well, but I cannot talk that deeply in a tax perspective. So for the layman's individual, I'm going to break down what you just said, and basically what Boone is saying in very high level terms is in the public stock market, you're typically going to be seeing a capital gain or a capital loss if you have losses. But when you exit a stock, if it's less than, what is it, Boone, a year, you're going to have a short-term capital gain. If it's longer than a year, you're going to have long-term capital gains, which is limited a little bit. There is a lower tax bracket for the long-term capital gains. With real estate, on the exit of the asset, the same holds true. However, Boone mentioned the losses. No, that does not mean the operator is poorly performing and delivering losses. What we do from a tax perspective is we pass through the depreciation to our investors, and we do that on an accelerated model. And so we take the majority of our depreciation in the first few years, and we will fully depreciate an asset in just under 10 years. And so that creates passive losses to go against the cash income that you may get on as it pertains to distributions from rent income or operating income along the way.
Yeah. So, all right, Brian, next question is coming to you, and it's going to be a multiple part question. So, why would someone choose private equity over keeping money in the stock market? And when you make that choice, do you need a financial advisor to facilitate those types of transactions? And how do you balance out what to keep in public versus reallocating to the private markets?
Yeah, really good question, and one that we actually talk with our clients and prospects quite a bit about. Ultimately, why would you want to invest in private equity? It all gets back to access. And so we talked a little bit about the number of private companies in the marketplace. I think it's also really important to look at return potential. And when you look at how a typical investor is allocated, this was a recent report that came out about a month or so ago. The average investor typically is allocated about 90% in public markets, about 10% in private markets. And I'll break that down a little bit further and talk about the 60-40 model. If you are an investor, especially if you work with an advisor, you probably heard of the 60-40 model, which simply means you should be invested roughly 60% in stocks, 40% in bonds or fixed income. And that's going to vary based on your age. The younger you are, the more aggressive you should be. The closer to retirement you are, the more conservative you should be. But overall, that's kind of the model. That's really changed a lot in the last couple of years, specifically because of the return potential in a lot of these private equity type investments. So the new model essentially is something called a 50-30-20 model. And that basically means you should put 50% in equities, 30% in some sort of fixed income or bond allocation, and then 20% in private equity. And then within private equity, there's a number of different asset classes. There's a number of ways you can invest. We'll talk about real estate a little bit further. But just to talk about the return potential, as you can imagine, because of all the things we just talked about earlier, because you have a more centralized decision-making process, because these firms tend to be more nimble and can be much more opportunistic, your return potential is obviously much higher. So I think about it in terms of averages. And if you invest in public markets in the S&P as an example, you're probably going to have good years for 3 out of 4 years. So 75% of the time, you're going to have a good year. 1 out of 4 years, you're typically going to have a downturn. Now, the past couple of years, actually, if I go back the past 30 years, that math is off a little bit. The markets, as we've talked about, are really, really highly valued. But I'm saying over time, that's about what you can expect in an average return, typically of around 9% if you invest in public markets. If you shift that to private markets, you're typically seeing positive returns about 4 out of 5 years, so 80% of the time. So that gets a little better, less volatility overall, but then you further need to break that down by asset class. And as we specifically talk about real estate, which is what we offer, your return potential can be significantly higher than that, depending on what type of real estate. There's core real estate, which is your traditional complex, maybe a newer unit, less than 5 years old with some amenities. That's kind of a core model, and that average return is around 9 or 10%. As you get into more value adds, these are ones that have greater appreciation potential overall. You might get into about a 10 or 15% on average return. And then when you get into opportunistic type deals, those average about 16 to 20%. So really the core of your question is, why would you look at it? It's number one about access, and number two, it's about return potential. And all of that goes towards building wealth as an individual investor.
And as you look into that, I think you brought up a good point. You've got roughly an average 9% year over year return if you look at a historical in the equities market, and that's gross. So if you're actually exercising on those returns, or a portion of, maybe you're going into retirement and you're liquidating assets on an annual basis, you're going to be paying taxes on that, and so that's going to net down after taxes. Whereas with real estate, you have the offsets that we were talking about, and so net, you've got a benefit real estate investment that returns a 9% annual rate of return versus an equities investment that does the exact same. And now the downside to that is capital lockup, as you mentioned, and or liquidity is what we talk about. But if you want to add to that a little bit, you've got market volatility versus direct ownership of an asset and what comes with that. Oftentimes we've got the headlines, whether it's political headlines, whether it's economic headlines, whether it's just uncertainty, or we've got war, or anything else that's going on has an impact on public equities. Whereas with the private markets, it goes underneath that really, and it does not impact them as much. And so, you can have inflation going on in the marketplace, and that can have, in times, a positive impact on private investments, and at times it can have a negative impact. But you've got a counter-correlated model to what's going on in the headlines at any given time.
Yeah, Ty, Brian, a good message, I think, is headlines are really the worst enemy of a public markets investor, because they tend to have the counter effect of what you should ultimately do. And that is, when you see a shock headline, the market's going down, the market's going up, you tend to make knee-jerk reactions because a lot of the securities, if not 90, 95% of them, are traded on a daily basis. Some are even traded intraday, like CITs. You can trade by the hour throughout the day. In the words of the great Warren Buffett, it's time in the market, not timing the market. So your point that you made earlier about private markets not being traded on a daily basis, or even a weekly basis, or even a monthly basis, sometimes a longer time frame, that actually can work for you more often than it works against you, as it relates to investing.
Good point.
Well, and one last thing I'd like for you to touch on, Brian, because I hear you talk a lot about this with our clients, is how to determine kind of how to weigh what to take out of your public portfolio and put in the private. And I know you use the example of your rebalancing of your Nvidia stock that you owned. Of when you own a stock for a long time, you've seen a lot of gains, and how it can kind of outweigh or grow into outweighing your or overweighing your portfolio. I'd kind of love for you to touch on that.
Yeah, I mean, there's what we call voluntary, and then there's involuntary asset allocation. So voluntary means I'm choosing to go in and actually reallocate my portfolio, whatever that may look like. I may decide to voluntarily allocate a greater percentage to bonds or to equities or to cash. Involuntary allocations, that happens when you sleep at night. And that's purely a factor of some things are going to go up and some things are going to go down. So, in your example earlier, and for any of our listeners who are invested in any of the Magnificent Seven companies, if you, for instance, 5 years ago held a 5% allocation, pick a company in Meta, in NVIDIA, pick any of those really highly valued technology stocks. If you started at a 5% allocation today by doing nothing more than sitting, that's probably worth 10, 15, in some cases 20% of your overall portfolio. So that's an involuntary asset allocation. And what every expert and advisor will tell you is you do need to make sure that your asset allocation reflects your current age, risk tolerance, and a number of other factors. So you do need to occasionally um, process voluntary asset allocation updates to make sure that your risk tolerance is appropriate. But you absolutely need to look at involuntary asset allocation and make sure that you're updating there to get your balance back to a reasonable level based on where it was. If you haven't looked in the past 5 years, certainly where it was 5 years ago.
Yeah, very very interesting. I love how the way you kind of explain that to some of our content, and you can really see it a light bulb go off in their heads, and really kind of understand of where they've got too much exposure in one place just from that involuntary growth. So, all right, next, Ty, what makes a private equity placement a good placement? What makes one a bad placement? How do you look at a pitch deck and evaluate the opportunity that's in front of you?
Well, an operator can make a pitch deck look pretty no matter what. So, I think it boils down to a deal's not a good deal just because it's exciting or because it looks pretty on paper. It's good because it survives all the stress tests. And so, what are some of those stress tests? And I talk about that from our perspective, oftentimes, and I refer to that as the four keys to wealth as it pertains to investments. And so, you got to start with your basis, okay? And so, when you start with your basis, and I'll compare this because we are asking, what is private equity, and we're kind of comparing that to the equities market. So if you're looking at just basis, well, it's what you invested in that investment. Whether if you're buying a stock, and let's say the stock is $100 a share, and you buy a share, your basis is $100, and that's the face value of it right there. Okay, but let's flip, and the unique side to private equity is when you're buying that basis, we're buying it at a discount. That's what we're looking for. We're looking for value add, and what comes with value add means that in real estate, you've got some deferred maintenance. You've got rents that are below market rate rent because maybe an owner has owned it for a long period of time and he hasn't focused on raising rents, or he hadn't focused on his management over the last few years, and so there's inefficiencies there. And so our basis, the focus there is to buy with equity, to buy at a discount because you make your money in the buy. Same holds true with private equity operating businesses. You're looking for a business that maybe it's a business that's operating very, very well, but it's a mid to lower tier revenue business. Let's say it's got $5 million of EBITDA, and on five or earnings before taxes and interest. So basically, it's your net income. And so with that $5 million of EBITDA, maybe they're operating on $12 million of revenue. But it's a business that you already have an ancillary business to, or it's a business that is the same type of business as it's a competitor, but the business that the private equity operator that you're partnering with already owns a portfolio company that is in the same line of business but larger. And so now you're going to have shared administrative duties, and so you can immediately get rid of some operating expenses on the purchasing company. So there's another opportunity for a discount. Okay, so the next focus is going to be appreciation, or how much calculated growth is there based on historical data. And so you're going to focus on that in a few different aspects. Number one, really conservatively, what can you allocate to growth over the next 5 years? And I go in and I'll assume that rent is going to flatline, number one, going into the market. And then I look for a market that has a certain amount of population appreciation. It's got a certain amount of median household income appreciation, and a certain amount of historical inflation from a microeconomic perspective. And so that then tells us, how are we going to structure capital over the next 5 years while we hold this investment? And we'll start out with equity, or with capital invested alongside some debt, and then we'll restructure along the way. And we'll base the amount of debt that we can put on that asset based on conservatively how much cash flow we expect, which that moves us into the next piece, the third piece, which is cash flow. And oftentimes investors, and I know you're going to talk about this here in a little bit, but they look at private investments and they say, well, I want to get into private investments because I want the cash flow. If that's why you're looking to get into private investments, you're looking at it very, very wrong. Okay, the wealthy, the extremely wealthy, we've got some investors that are worth 50, 100 million and plus. They don't look at, oh, I want to invest in private equity and I want to generate 10% cash flow year over year. That's not what they're looking to do. They want 3, 4, 5, 6% cash flow, and then they want to see the maximum amount of growth and efficiency on their money invested. But cash flow becomes a huge, huge offset to risk, because the quicker you can get cash flow and distributions by stepping in, implementing the business model, putting that business, that piece of real estate, whatever it is, to its optimum operation cycle, and the faster you can get cash flow, the quicker you de-risk your overall investment. Okay, and so those are the first three aspects. And then the fourth one is, what tax advantages are going to come along with this investment? How is it going to help me grow my wealth more effectively and more efficiently from a tax perspective? And then really the final thing that you look at, as I mentioned, you make your money in the buy, but what's the exits, the exit opportunities? And we look for multiple exit opportunities, right? Selling an asset, whether that is refinancing. We've had significant growth. Maybe we're looking at an asset that's got significant growth opportunity to it, and we're going to have the opportunity to refinance and pull all of our invested capital out, plus more than what we invested, which we've done a number of times. Maybe we've got a $10 million investment that we purchased, and we've got $7 million of debt and $3 million of equity, and we step in and we refinance at $12 million because of the growth in NOI along the way. So we're able to pay off our first position loan. We're able to pull that $3 million that we invested out plus an additional $2 million, and then we hold that asset long term and still see cash flow coming from it. And so what are the exit potentials? And then obviously you've got owner financing and some sort of a terms deals, which oftentimes end up in your best overall exits from an investment perspective. And then the next thing that you're going to look at is the sponsor themselves, the operator. What's their track record? Do they step in and say, I've never had a loss? Well, that probably means they've not been in the business long enough or they're lying to you. So what's their track record? What have they done during great times? What have they done during bad times, and how did they communicate the problems that may have come up in a deal? And then what solutions did they have? Because oftentimes an operator may step in and they underwrite a deal and everything looks great, but it's no different than a boxing match. When you step in that ring and you get punched by a right hook when you were expecting the boxer to give left uppercuts the whole time, how are you going to adjust? And what adjustments are you going to make along the way? What's their communication style? How disciplined are they? Are they disciplined enough that when the market tanks and everything around is going wrong, are they disciplined enough to hang on to the investment, to stay the course, and to keep operating forward, putting solutions in place instead of washing their hands and walking away? And ultimately, all of those things are really what creates alignment in the long run.
So we're going to dive into one of those points a little heavier, which is the cash flow point in this next question. Brian, I'm going to come to you first. What is the biggest misconception investors have about returns in private equity? But in that, I want you to talk specifically first about what misconceptions do they have about distributions? Does distributions always equal and mean positive cash flow? And are there ways that public companies utilize distributions when it's really more of just a return of equity rather than a true positive cash flow opportunity?
Yeah, that actually comes up quite a bit as well, because if you have invested in public markets, you're probably used to some sort of fixed income. I invest in a CD at my bank. I've got a bond fund or a U.S. Treasury note that has a what we call a coupon rate. You might have a $100 Treasury that pays a 4% coupon rate, and they're paying you 4% per year. And at the end, when it matures, you get your principal back. So that's what a lot of people, I think, are used to. How that differs a little bit in private equity markets is distributions are really a factor of earnings and a calculation that goes into effect. That doesn't necessarily mean that's automatically sent out. It could be. So you can have distributions or earnings that are accrued. You can have distributions or earnings that are actually distributed and sent out. But that's a little different than it works in public markets, where it is a coupon or a yield rate, as compared to private equity. And so, to your point earlier, how do public companies actually calculate yields? That can vary quite a bit, also based on the structure of the company. There are some, and this also gets into the structure. If you invest in a mutual fund, which is nothing more than a bucket of a lot of different, a combination of stocks or bonds or other publicly traded instruments, that calculation can be based a number of ways. It can be based on the underlying investments and the quote unquote yield that is accruing or distributing in the underlying investments. That can also be based on new contributions that are coming in. That can actually factor into a cash flow percentage or even a return percentage. So it's really important as a public markets investor, whether that's a company that you're investing in or another type of arrangement like a mutual fund, to really understand what is that quote unquote distribution or yield, and how is that ultimately calculated, and how is the underlying investment able to continue to pay those overall. With private markets, it's going to work a little bit differently, because obviously that's going to be based on transactions and earnings that occur throughout the life of the cycle. And Ty, I think, can talk a little bit more about specifically how cash flow works in private equity markets. But it's something that we get a lot of questions on. You know, if I invest in a private equity instrument and it has a specific preferred return rate, is that something that automatically gets sent out to me? Is that something that gets accrued, or is that something that gets sent out on a regular basis? And the answer is it really varies.
Yeah, and I think one of the biggest misconceptions that I've seen that investors have as it pertains to maybe quote performance in private equity is they think distributions equals performance or results. And that is absolutely not the case. It couldn't be further from the case. Oftentimes the goal the goal is a controlled exit, okay? Not a monthly dividend product, okay? The goal is how much are we going to grow this investment so that we, number one, have a tax advantage, and number two, maximize our overall investment along the way. If you only judge a private investment by cash flow today, then you're going to miss the overall wealth creation. And that's where the extremely wealthy have built their wealth in private investments. It's in the exit multiple. How many times over can you turn your money in the shortest factor possible? And so cash flow, yes, cash flow plays a little bit in that equation, but it's not the focus of that equation. And if you're looking at those four keys that I was talking about, that I talk about all the time, equity or buying at a discount, appreciation, what's your factored growth, and what can you expect based on history for your investment to grow by, and that's focusing on micro and macroeconomics perspective as well as operations, and then cash flow and tax advantages. Well, cash flow is going to fall into the last one, the least most important. Yeah, we want cash flow on most of ours, but there's actually some investments that I've underwritten that are fantastic investments. Some of our top 10 investments that we've had that don't have cash flow along the way. Heck, in some of the best markets, new development. Well, new development never has cash flow. But that can be some of in the right market. New development is not the right market today. We do have one new development project going right now, but we've sat on that dirt for a long period of time. We bought right, and we've been waiting for inflation to come down a little bit to start the materials focus on that. But, new development can be a great opportunity, but there's no cash flow there. Now, the great opportunities right now are because we are buying off of a bank tape where a bank is stepping in and either forcing an operator to walk away, or the operator just doesn't have what it takes. And this industry can absolutely eat you up, especially when there's turmoil like what we've seen for the last 3 years, and or operators just don't have the equity. And so with the opportunities we're seeing today, we're going to have massive buy side opportunity, and that we're buying at a significant discount. Sure, that'll create cash flow, but overall, make money in your buy and focus on investments that, number one, you've got the equity on the front end and are going to appreciate over time based on your operations management and operational control. And that's where your focus should be, is on, how do you control the asset along the way, and how do you control the exit? So
you talked about new development, and that it doesn't produce, obviously it doesn't produce cash flow, but obviously you sometimes have operators that predominantly only do new development, yet they still claim distributions or promote distributions. Walk us through how a group that only does new development, which obviously is not going to put off any positive cash flow because there's no income, how do they still get around and do distributions?
Well, there's a group right now that's in a class action lawsuit for that. That was a large private equity group, and at the end of the day, yeah, equity growth plus deleveraging is going to be your overall focus, and that's across any investment, and that's going to be more so focused than cash flow. But what ends up happening is when large groups of the market come in to look at something new and they have misconceptions, then you've got the price beaters that go out there and try and beat other operators in the market by being the best offer or best price, if you will. They try to be the Walmart. And that's not ever going to happen, because at the end of the day, you've got the BlackRocks and the Blackstones, and those groups have set the standard for cheapest cost of capital. And so what ends up happening is you've got these developers that'll come in and they'll say, yeah, we'll pay cash flow along the way. And what they often do is they sell the investment as a completed project on the front end before it's ever completed. And they bring in the capital and they structure the capital stack based on a completed project. Then as they bring in the capital, they start to develop the project. And so now they're able to pay out distributions with new capital coming in. Because let's say an operator bought a piece of land for $1 million. They're going to develop a new development for, they're going to do the horizontal work. They're going to do all the flat work and everything for another $3 million. So they're all in at $4 million. And then they're going to spend $16 million on the vertical development. And it's going to be a $20 million flat cost. But then once all of the $20 million development is done and they lease up the asset another year later, after the work is done, the value of the asset based on NOI is $28 million. What they do is they end up selling the project for $28 million to investors on the front end before they recognize or before they develop the asset and accomplish the overall value. And that, number one, is just lining the operator's pockets on the front end. There's a lack of alignment there. Number two, they're paying distributions based on capital coming in, not based on recognized growth. And so they run the risk of, first investors in and first investors out get their money back out, but the back end investors don't ever get their capital out because the asset never meets its full potential. So we've seen that. And then Brian, I'm curious, we've talked about REITs before. So REITs have a distribution requirement that's built in and calculated in. And then furthermore, many of these large REITs and or large private real estate investment groups that are some of the largest ones in the country have structured into their bylaws where regardless if the investment fund is operating at a operational loss or operational net positive, they allocate in new capital coming in as a distributable form of income as well. So share with us a little bit about that.
Yeah, that's something that we've seen more and more, where you may have an investor who is invested in a REIT and they, I'm doing air quotes here, show a positive return. But if you get the latest prospectus, they're typically updated on a quarterly basis. Dig into the earnings because it's going to show the underlying investments of that portfolio and the operating income and the ultimate net profit. And interestingly, for one of the larger private equity REITs that are out there in the marketplace, they've had positive returns for the past 5 quarters, but negative operating income for the same past 5 quarters. So then you have to peel the onion a little bit further to look at how are returns actually calculated. And to your point earlier, it can factor in new money coming in. So that actually goes towards the return metric, which you could argue is probably not the most accurate way to factor in a return. So that's one big method that they can actually do it. And you really have to dig in to understand how they're calculating it. The second thing that can be done, and this is going to vary by fund, but they can set their own NAV, which is net asset value. So when you buy a REIT, it's a fund, and that fund is going to have a price, like a stock has a price. Well, the originator or the sponsor of that fund can set that NAV, that net asset value. It could be $10 a share, it could be $20 a share. Well, where that then moves is going to determine ultimately what that return and that performance looks like on a day-to-day basis. So if you can move the goalpost, and you can also change how that metric is calculated, it really can be a little difficult to understand as a traditional investor who may not have the expertise to get a 400-page prospectus and actually dig into some of the financials.
So that actually is a good leeway into our next question, which talks about, how does our private placements actually make money and make returns? So Ty, I would like you to walk us through a little bit about how does so we operate obviously as a fund. There's a difference in single syndication, single operator syndication, and funds. We operate as a fund. Walk us through, how does our fund make money? And then how does that pass through to the limited partners of our fund?
Yeah, so I'm going to kind of talk through a couple of points there on that. And as you mentioned, how does the fund make money, first of all? And then secondly, how does the investor see that, or what is the capital structure thereof, and how does that work? So ultimately, the fund makes money, the investments make money. Number one, by buying assets right. I already discussed about that. We're looking for a discount, whether it's a discounted loan payoff, which is what currently we've got our Lasater Capital Fund 14, which is a huge opportunity right now. It's one of our most successful funds yet. And I haven't seen this much success since I was talking to a couple of our investors today that are placing capital that are in some of our other funds, and they're putting capital in Fund 14. I haven't seen this kind of opportunity since 2009, 2010. And so how we're making money right now is we're negotiating discounted loan payoffs, whether it's an operator that does not have the liquidity to come to the table to refinance and pay down the loan. It's an operator that is in over their skis and they don't have the ability to manage the negotiations with the lender, or if the lender is just so fed up they've already stepped in and taken over the asset. The benefit right now is all the lenders wants these assets off of their books and they want to reset capital. So if you're a good operator like we are, you know how to negotiate those opportunities and work those opportunities within your own portfolio. If you're not, you get stressed out really quickly by the lender calling you daily and asking questions that you don't feel like you can ever overcome. And so it creates an opportunity for groups like us to step in and say a group has an asset that they purchased for $20 million, they got a $15 million loan, and they have so much lender pressure right now, they don't know how to deal with it, and they're walking away from the asset with a $15 million loan on it. Well, that lender is not going to turn around and immediately sell it for $15 million. We're going to step in. We're going to negotiate that down to $12 million. We're going to step in and buy that $20 million asset for $12 million that needs another $2 million put back into it to recognize its full potential of $24, $26 million. And so that's creating huge opportunities. That's the opportunity in the buy. That's where you first create and make money in private real estate. Then once you've acquired it, you're going to step in and you're going to focus on operations. We're going to do those renovations so that we can improve tenant quality, so we can improve occupancy, so we can improve the overall average rent on the property and get closer to a market rate rent. And that's going to increase cash flow. That's going to produce NOI. So that does produce a little bit of cash flow, as I mentioned, but that increased NOI increases the value of the project as well. So we've made money in the buy. Now we've made money in the operations as well in two factors. Number one, cash flow, but in two, in appreciation and growth. And then we're going to restructure the capital stack again. We're going to bring in lower leverage, better terms. We're going to have more leverage to negotiate with our lenders at that point. And then we're going to look for the right market to exit in. So that's ultimately, the money is made in the buy and it's protected in the capital structure along the way. Then how does our investors make money? Well, there's what's called a waterfall in private equity. Okay, and this is what creates alignment with the operator. Okay, and so the first thing that you're going to look for is what's the preferred return? And a preferred return it's an allocation of the waterfall to the investor. As an investor, you should care about that because it creates alignment. So let's say you place $100,000 in an investment, in a private investment. That $100,000 is going to have an order in which it and the return on that money is paid out to you. Okay, and so the first order is going to be that preferred return. There's preferred returns anywhere from 4% to 20%. And it really varies depending on the investment class. And oftentimes when you see really, really high preferred returns, they're typically fixed. I'm talking 16, 18, 20% preferred returns. It's typically a fixed preferred return. You don't get a share of profits over and above that. And typically the operator is taking a huge fee on the front end that they're hiding in the disclosures in some capacity. And so oftentimes you see that in the development deals, like I was talking about earlier. You see that in a number of instances where an operator will pitch a really, really high preferred return, and it's a fixed preferred return it's capped, and then they're taking their fees on the front end. They're not worried about long-term alignment. Okay, and so as an investor, you should care about long-term alignment. So what we do, we structure our preferred return based on the amount of capital that an investor places with us. If you're an entry level at the entry level of our investments, you get one preferred return, and as that investment amount grows, you get a larger preferred return. That preferred return, all that is that's the percentage on your money that you're going to get paid before we, the operator, get to partake in a split of profits. Okay, and so that creates alignment with the operator, because we don't take a big fee on the front end. We have anywhere from a 1% to 2% management fee. Okay, and so we're not taking a huge management fee along the way. 1% for our higher end investors that are on the upper end, and 2% for the entry side. And so we are looking to participate in the profits. We want those investments to perform as well as possible so that we get the highest profit split as possible. So after the preferred return, you start to see a split of profits. So the way that we structure ours is if you invested $100,000 and you're getting, let's say it's a 6% preferred rate of return. You earn that 6% each year over year, as long as your $100,000 is placed. If cash flow in year one is only 2%, you're still owed 4% before we get any split of profits. So once you've been paid, let's say after 5 years, we exit the investment or whatever it is. So let's say that you've been paid your 6% per year for 5 years, you've gotten your 30%, then you get your money back. Okay, so once you've gotten your preferred return and all of your investment back, everything over and above that is split. And that split varies anywhere from 50-50 up to 90-10. So in my example, let's say you invested $100,000. Year one, you got 2%. Year two, you got 6%. Year three, you got 10%. So now you're caught up in years 1, 2, and 3. And then in year 4, you got 12%. So actually what happens is the first 6% goes to pref, and then the next 6% actually pays down your investment. So your $100,000 investment only has $94,000 left on it. And then we move forward till we sell the asset. And once you've gotten all your money back and your preferred returns, then there's a split 70-30, 70% to you, the investor, 30% to us, the operator. And then we've got investments that pay a 14% preferred return, and they do a 90-10 split of profits, 90% to the investor, 10% to us. So that's how you make money, first of all, in the deal, second of all, as an investor in the fund.
Does a preferred return equate to a guaranteed return?
No, not at all. So a preferred return is really just the difference between a partnership and a payday for the sponsor. Okay, it creates a partnership. The preferred return just means that you, as the investor, are going to get that amount of a return each year in total. So it's not necessarily that you're going to get that paid out in cash flow that year. It means that you're going to get that amount year over year through the life of the investment before we, the operator, start earning any profit from that investment. And rest assured, I am not in this business to not make money. We are in this business to make as much money as possible. And we do that by creating the highest performance on an investment as possible.
So going into our next question, I want to talk about the current economy that we're in. Brian, I want to come to you. So I want to talk about opportunity. And right now, I want to talk about two different types of opportunity. So we have the opportunity in the public markets to execute getting out after seeing quite a bit of growth over the last several years. So exercising some gains. And we've got opportunity in the private markets of getting into things such as real estate at really attractive bases right now because of what Ty just kind of went over with what we're seeing from banks wanting to offload stuff off of their balance sheet. So I want you to talk us through a little bit of what makes the situation we're in right now a good opportunity.
Yeah, earlier I talked a little bit about the average number of years that public markets perform and have positive returns versus negative. And the same thing with private markets. We have several stars that really, in the last couple of months, have aligned in a way that creates really this great opportunity that's not going to last too much longer. And that is this. You mentioned public markets. Public markets are record high valuations. We've already seen a lot of volatility this year. In fact, year to date, here we sit in the middle of March, right before tax day, 2026. We're about even, a little bit negative for the year. So we're already starting to experience some volatility. But historically, again, record highs in the public markets. We've talked about valuations also being at record highs, driven largely by the big technology companies I mentioned earlier. At the same time, you've got record valuations in real estate. And a big piece of that is from what Ty mentioned earlier, these discounted loan payoffs that are available through the banks. So you have banks that are very willing to negotiate for 20, 30, 40, 50 cents on the dollar. And so we can get into an asset at a significant valuation differential compared to what it even looked like a year or 2 years ago. So you've got record high markets, although that's corrected already to some extent. You could almost argue 2 months ago was the best time to do this. I think we're still in a very good window. You've got record low valuations in the real estate market. And what most investors and what the smart money is doing is they are looking at simply rebalancing, getting back to what we talked about earlier, where you get to a more reasonable allocation of overall stocks versus fixed income versus private equity. And at the same time, get to a more reasonable allocation of your overall portfolio. So that window, we don't know exactly what that is going to do as far as timing. How long are banks going to be willing to negotiate the way that they have been? How long before the market takes a more significant downturn? Only the future will tell us that. But we do know that today, right now, in the middle of April, we've got an opportunity that's been around for a few months. I would say it may be around for another month or two, and then that opportunity window starts to close in a pretty significant way.
Well, one of the oldest investment, philosophies to follow obviously is buy low, sell high. And you've got, as you said, record highs in the public markets right now and really great opportunity at low bases in the private markets. And so it's a great time to pounce on both of those opportunities.
We see in markets like this, and specifically, we see huge opportunities in private equity during markets like this because at the end of the day, in chaos, liquidity is a superpower. And so what we're seeing right now is really good assets with bad loans or disproportionate loans, and those are being repriced. So really, we're making this maybe on this episode, and a lot of the times we talk about it, we make this sound maybe easier than it is, and we say, lenders want these debt off of their books. Lenders want resolution, willing to take discounts, and ultimately they are, but they're not pushovers. These lenders are absolutely not pushovers, and oftentimes I get asked, how do I show up every day? I've had a number of other operators ask me how I walk in so calm, cool, and collected during chaos like this. And I look back to, I've had 6 knee surgeries, 2 collapsed lungs, lung surgery, and it's things like that that have molded me for chaos. And Boone, same with you. And with everything that's going on around us, lenders that are calling daily, showing up on properties, then coming in with a litany of lists that they're trying to force and mandate us to do. And what they're doing is they're looking to see how strong or weak of an operator you are. And if you show an ounce of weakness, they will absolutely take advantage of it. But if you show strength, they will start to negotiate. Now, you sometimes have to implement strategies that are out of the ordinary in order to force the lender's hand to negotiate. But at the end of the day, they are looking for an operator that is willing to find a solution to get that loan off of their books, and they're willing to take a discount to do so. And that is what is creating opportunity in this market, because there's too many operators that don't have ultimately the background that we do, the tenacity that we do, and they fold under pressure. And that creates an opportunity for the operators like us that have the liquidity in order to execute on those opportunities.
Yeah, Boone, I would say one final piece around that, around the opportunity is we are starting to see some proposals for banks specifically to loosen some of those regulations. So that's another factor that we're looking at right now. As everyone knows, there's a lot of rules, a lot of regulations that the bank have to follow. And there are a number of proposals to loosen those, which does lend itself to potentially some of these DPO negotiations that are underway. That window to also possibly close in the near future. Right, Ty?
Yep.
Absolutely. We've got a short window. At the end of the day, we've got a short 12-month window. And yeah, you say, well, 12 months sounds like a long time. That it happens like that. If you're not already negotiating those opportunities, then 90 days from now, you've already missed that window to really execute on the closings that you have lined up. So it's going to be a short window. And if you're sitting there looking for opportunity, you need to be taking advantage right now of this of what this market has done specifically to private equity and the opportunities that it has created in private investment real estate.
So next, Brian, I want to come to you because you have an interesting perspective in that you've been in the public markets before. You still work with a lot of people that are in the public markets. So walk me through why don't, we have a number of investors that obviously work with financial advisors. Why don't most financial advisors recommend private equity, and why are some, hesitant to place their clients' money into private equity?
Yeah, it's nearsightedness. It's comfort. I am going to recommend and suggest what I'm comfortable with. So if you think about the typical public markets type investment, if you're a financial advisor, it's a heavily regulated industry. There were a number of acts, the 33 Act, the 34 Act, the 1940 Act, that regulate these types of investments. And any financial advisor out there has undergone a lot of training and a lot of licensing to really be an expert. And they're a great source of information, and really true. To get those licenses, you do have to be a qualified expert. So they're comfortable with aspects of public market investing. And so when something new comes out, years ago, there was something called viaticals, and it was basically a form of buying into life insurance contracts and the future payout benefit. It was kind of this new concept that actually was a really good concept. Now, you could argue whether or not long term it had a lot of merit, but advisors were very weary to get on board with some of these new concepts because they didn't understand it. Once you heard them understand it, one of the biggest advisors that we have here in the Dallas-Fort Worth Metroplex literally overnight changed his whole business model and started selling this new type of investment that just a few years before was virtually unheard of. And so it's familiarity more than anything. I know what I'm comfortable with, what I've been trained for, what I'm licensed to sell, and that's what I'm going to go forward with. The other thing I would say is most financial, if not all financial advisors, are going to use some sort of platform. When you call in as a client, you're in a record somewhere on a system, and they need to be able to pull that up. And when you want to place trades, they need to be able to trade. And so public market securities are widely available on those platforms. If you pick any of the top providers out there, a Charles Schwab, a Fidelity, you can buy IBM stock or any, mutual fund on those public market platforms For private market platforms, it's a little bit of a different process. There's some due diligence that gets involved. There's going to be some underwriting that has to happen on behalf of that placement provider. And there are a number of, I'll say, very specialized marketplaces that are now growing and becoming more commonplace in order to make these types of investments more available to the average investor and to the average advisor.
Todd, do you have anything to add on top of that?
Yeah, I mean, Brian mentioned that it comes down to familiarity, and then with familiarity also comes an understanding of the advisor's AUM. And when they don't have a familiarity with the investment, and then furthermore, it's difficult for them to either see the value in it for them selfishly, and or they don't understand where they're going to get compensated, because at the end of the day, when a individual investor allocates assets from, let's say an investor we've got a client that's got, he's got roughly $10 million. He had $10 million in equities, and then he ended up allocating roughly $2 million with us. It was about 1.6 million. That 1.6 million came out of the AUM of his financial advisor, and ultimately decreased the fees that his financial advisor was going to earn. Now, this particular investor is very active in where his capital goes and how it's managed, and he has that conversation with his financial advisor very easily. We also have a bunch of clients that they don't really know how to have that conversation with their advisor. And some of our clients are able to, we are on some of the platforms, and they're able to explain and or bring us in on a call and explain to their advisor how their advisor can allocate it via whatever platform they're on and still earn their fee. But then we've got some that don't understand it, and their first instinct is to tell their client, no, don't do that, because they don't understand it as the advisor. They know that it's going to remove AUM from their portfolio and decrease their overall fees, and they no longer can really, hit the easy button. And I'm not saying that their job is easy by any means, but I'm just saying that they no longer can deal with the familiar. They're having to deal with the unfamiliar, and so it makes it harder to move. A confused mind doesn't buy. At the end of the day, a confused mind doesn't buy. And if the investor is confused and the advisor is confused, then it doesn't create a pathway for that investor to move forward.
So that actually is a great segue into our next question. Talking about familiarity. Familiarity equals easiness and comfortability. And we like creating a product that is easy for our client to understand, to know what they're going to get and know what they can expect. So why don't, Ty, you walk us through a little bit about what a client should expect from a communication standpoint, a timeline, a liquidity, and a reporting standpoint.
Yeah, this is going to be a good one. I've got some input there, and then I look forward to hearing Brian's perspective, because he came in, we've been in business for 22 years. We've been working with investors for over a decade, for almost 12 or 14 years now. And then we've been working specifically with funds for I guess 8 years. And Brian, you've only been here for a little over, I guess, right around a year at this point. And before you, we had Steven for about 5 years. And so I want to hear your perspective here as well, by coming in and you really getting to talk to our 750 plus or minus investors and hearing their perspective. And we've got a wide gamut of perspectives there. We've got some that had history in private investments. We had some that have no history in private investments, and those that have no history in private investments, some got a good understanding and set of expectations when we onboarded them, some maybe not. So, I think the first thing is setting expectations clearly from the front end. And the number one expectation that seems to be a mis. Private equity is not and does not have daily liquidity. And another thing that, misconception that we have is, I say we have a 5-year fund. Well, that fund, we expect to exit. We expect to exit the assets in 5 years. However, if the market is not right, we are not timing the market. We are timing the investment. Okay. And so if it is not right to exit the investments at the end of 5 years, then we may hold the investment until year 6, 7, or 8, whatever the case may be. And so there's a misconception that there's either liquidity along the way or it's a finite investment cycle. It's 3 years, it's 5 years, or whatever the case may be. That's not true. The other thing is really reporting cadence. What does reporting look like? We do quarterly reporting. K1s. When do K1s come out? Everybody thinks that they should be able to file their tax return on April 15th. If you're in private investments, number one, you should not be filing on April 15th. That actually increases your audit potential, the IRS auditing you. If you are consistently April 15th filer year over year over year, and you have K1s, multiple K1s, that the IRS knows that operators deliver K1s and they file extensions to deliver the K1s. So if you're filing your return on April 15th and the IRS knows that there's a 90% likelihood that K1s are filing extensions and you're not filing extensions, then you're increasing your audit risk. And so,
and there's just the cycle of the tax year. The later you file the tax year just equals the lower you are in the queue of having your tax return looked at. Whether that's good, bad, and different, it is they only look at so many, then they cycle over to the next year.
That's exactly right. Very, very good point there. And then on top of that, it's the involvement and what goes into producing the K1s. But how many K1s on a yearly basis? So we've got 750 investors. We've had 14 funds. We produce thousands. We produce more K1s than some CPAs produce returns. That's just from us alone. So that takes time as well for our CPA to prepare and put that together. So ultimately, what is good communication? It's clear updates. It's bad news delivered fast. We don't sell ice cream. You have not partnered with us to only give you good news. You have partnered with us to have a passive approach at investments so that your money is working as hard for you as you are for it. And you want to know the bad news quick. And not only do you want to know the bad news, like some operators will step in. Like I know for a fact, I can name off 5 operators within about our size that have issued a Dear John letter this year. Dear John Doe, your investment is a full loss. Nothing else. They waited until the investment was gone and then delivered that news. Instead of communicating along the way, hey, here's an issue that we have. Here's 3 possible solutions. Here's an issue. Here's solutions. You've got to be partnered with somebody that is solution oriented and delivers the bad news quickly so that decisions can be made. So good communication is huge because how you plan is how you succeed. You've got to be able to plan forward. So if you need daily liquidity, then private equity is absolutely going to frustrate you. But if you want your money working as hard as possible for you, as hard as you've worked for it, then private equity is a great opportunity.
Yeah, private equity is not a savings account that you can put your money in and look to withdraw it at any point. You've got to be, Warren talks about equating this to the public sector. Warren talks about all the time that if you don't have the stomach for your portfolio to dip 50% and you be okay with it, it's very similar in the private markets. If you don't have the ability to risk what you're putting up, then you probably don't have the ability or stomach to make it as an investor.
Well, and not only risk it, but if you don't have the ability to put that money there and forget about it for 3, 4, 5, 6, 7 years, okay, that money is going to go there, and it's got a long-term plan, not a tomorrow plan, not a next week, next month, next year plan. It's got a long-term plan to fruition, and a lot of things can happen during those 5 years before we ultimately get to the exit position.
Yeah. All right, well, that's going to take us into our last question of the evening. And so we have, at Lasater Capital, we have a ton of different people or types of people that make up our client base that are, high net worth individuals, institutionals. There's lots of different things that makes up a high net worth institutional. Some people inherited a bunch of money. Some people won the lottery, whatever. Some people have worked really hard and saved over a life careers of work. And then you have the group that is the golden handcuffs, the people that are high wage earners. They earn
We've got a
massive
bunch of
living.
those. Doctors.
Doctors are a
Athletes.
great
We've got a
example.
bunch of professional athletes, a bunch of doctors.
It's people that earn a phenomenal wage, but also pay a phenomenal tax burden to the IRS. Where our real estate offerings could provide a great benefit to them. Walk us through somebody that's in that position. What's the first step for them to start getting their money working for them, and how can they partner with us?
So I'll start off there, Brian, and then kind of hand it over to you as well. So, if someone's a high income earner with golden handcuffs, and like you said, Boone, we've got professional athletes, we've got a lot of doctors, we've got a lot of entrepreneurs, we've got retired individuals, and executives. But golden handcuffs, where you're still actively earning income, a high income. What's the first step to getting your money to working harder for you? Is number one, stop chasing shiny returns. Build a sustainable plan. Okay, and that plan, is going to come with a couple of different facets, and really it's going to go back to those 4 keys to wealth that I've talked about earlier. It's diversification and tax efficiency. How can you maximize your investments? And as you maximize your investment returns, how can you build a tax efficient model around those? So, you really want to allocate, and that goes back to, Brian, what you were talking about, that 50-30-20 model. And we're seeing more and more family offices being, and whether it's an individual or a group of individuals that are worth $100 million or more. We're seeing more and more of those family offices really changing that to more of almost a 40-30-30 model. And in some cases, even higher in the private side, getting more of a majority on the private side. And so it goes back to intentional allocation. How should you be allocating your portfolio? If you're worth $1 million total and you're planning to retire in the next year, well, number one, it's high likely in today's society you don't have enough to retire. I was reading an article the other day. What is the right number now, and that's creeped up well over $2 million, and that's for a majority of America. Most of our clients are in the top 10%, maybe not the top 1%, but top 10%. And so for a top 10%er that's wanting to maintain their lifestyle, that's $5 million, maybe more. So what does that allocation of that $5 million look like? And so, then from there, it's really focusing on investments that are going to deliver a majority of those 4 keys to wealth. You've got to be able to invest in something that you're getting at a discount on the front end, because that's where you're going to make money in the buy. And then you've got to invest in something that has historical appreciation and growth to it, and calculated growth. And that goes back to what I was talking about earlier, why the extremely wealthy focus on private investments, because it's ownership. With ownership equals control of the outcome. when you're investing in an operator that by implementing the business plan, the investment's going to grow, not worrying about what is going on in the headlines and what your investment's going to do tomorrow because of the headlines. It's focusing on what is the business plan, and if this business plan is executed, how much will that investment grow? Ultimately, and then as it's growing, is there some cash flow along the way? Then when you couple a tax advantage with those three aspects, now your money is working harder for you than you are to earn that high income with those golden handcuffs. So,
Yeah,
Brian,
Ty, that tax aspect is so important because any investor, but especially high net worth investors, really don't consider that near enough. So, I would just agree with everything you say. I would say you've got to be intentional. Don't let another day go by until you think about what the right allocation of public markets, private equity, and real estate should look like. You don't want to be a Monday morning quarterback in a year from now say, boy, I sure wish I did X back in April when we saw kind of these stars align. So, the biggest thing is avoid the myopia of kind of what's been going on and be very intentional about your allocation moving forward. And we've talked about it, you just touched on it, but taxes, taxes, taxes. You have to prepare yourself to be intentional and successful as it relates to your after tax return, but also after inflation returns. Not enough people think about that because it may not feel like it impacts you as much when you're in that type of wealth bracket, but it impacts everyone. I mean, cumulative inflation since the beginning of COVID, well north of 20%. And I have heard advisors say you want to save about 75% of your pre-retirement income into retirement. I've actually seen that change a lot to about 80% or even higher now. So if you made $100,000 pre-retirement, you need $80,000 in income. And chances are, if you and a spouse are both living at retirement, and that age is about 72, that's when required minimums begin, chances are one of you is going to live at least another, believe it or not, 25 to 30 years. So most people think at retirement, I may only have 10 or 15 years to think about. Well, individually, that might be the case. If you are married, you need to plan for a long time horizon and be very intentional and consider taxes and inflation.
and with modern day, that's just growing. And you know, probably the three of us on this video right now, you bring up a really good point around inflation. I know I typically don't pay attention at the gas pump. Like that, at the end of the day, that doesn't impact me and my month, what gas prices do. That being said, all three of us, one of my vehicles is a big truck. We all three live in Texas. Brian, you've got a very similar truck to mine. Boone's got a truck as well. But my truck now at the gas pump, when I fill it up, it actually gets shut off before it even fills up because I can't put as much fuel in my truck as the gas station allows. And so with that, when you're putting that amount of fuel in and prices are $5 a gallon, you know, inflation does impact everyone, like you said. And so, you know, somebody that's with the golden handcuffs, yeah, your income is super strong, but inflation and taxes are stronger than your income is, no matter what, if you don't structure your capital properly. And so, you know, having investments that are counter correlated to inflation, that are tax efficient, become one of the most important things as you start to focus on retirement, when your retirement is one of the most uncalculated things that you can have. You may live for a year into retirement. You may live, as you mentioned, 25 or 30 years into retirement. Are you prepared for that? You know, and right now we've got our Fund 14 open, and our real estate, Lasater Capital Real Estate Fund 14, you can check us out at lasatercapital.com. lasatercapital.com. But our Fund 14 fund is structured exactly for those two factors. We are buying assets at reset pricing. We're going in, we are resetting the market because we're not buying from an operator. We're not paying equity to an operator who's operated a deal. We are resetting the buying price right now across the market because we are negotiating with lenders at less than what the loan is on assets. And so with that, we're able to build in very disciplined leverage, which creates very structured returns. We can calculate what those four keys are for an investor who is coming into our fund right now and what that ultimately looks like. So that being said, Boone, Brian, do you have anything to leave us with on this episode number 17 of The Growth Factor?
No, I think we've covered a lot. We we went over what is private equity, how do we access it, how do we rebalance our monies. So I think that's it for this week. So people, stay smart, stay sharp, invest in growth. We'll see you next week on The Growth Factor.